This is your accounting buddy and welcome to the channel. Today we're going to be looking at deferred tax liabilities part 1. I am going to be doing a second part, a third and a fourth. Actually there's 4 parts to this deferred tax series, where I'm going to also be looking at deferred tax assets and all the rules that are involved and how to do those calculations in detail. So do enjoy the series. Hit the subscribe button if you haven't, so that you don't miss out on any future videos. So deferred tax operates on a set of rules that we are going to have to follow, and in this tutorial I'm going to show you one rule, the first rule, which is also very important, which says the carrying amount of an asset must be greater than the tax base of an asset, which is going to in turn give us a taxable temporal difference and a deferred tax liability. The temporal difference comes from the difference between the carrying amount of an asset and the tax base. Now here's an example that we're going to be looking at. This one is going to be very informative, guys. Now for this one we have a building which at a cost of 500,000 on 1 January 2019, and a similar tax base, right? It was acquired the day the company was formed. Now there's a depreciation here. For simplicity forms, I just wanted to make this one very simple. We have a depreciation of 10,000 rands and a tax allowance of 12,500 rands, excuse me. Now depreciation relates to the carrying amount, right, in terms of IFRS and accounting rules, and the tax allowance, this is in terms of the income tax, is a tax allowance. The tax allowance affects the tax base and the depreciation affects the carrying amount. So after the depreciation of 10,000 rands in the 2019 financial year, our carrying amount at the end of the year gives us 490,000. We quickly do a calculation here on our calculator and you're going to arrive at a figure of 487,500. Now clearly there is a difference between these two figures right here, and the difference, I'm sure if you do your calculations on your calculator, will give you 2,500 rands. Now this is our temporal difference. We call this a temporal difference. Now since we have a temporal difference here, and our law or our rule here says if the carrying amount of an asset, a building which is an asset, has a carrying amount at the end of the year, we always have to look at the carrying amount at the end of the year, is greater than the tax base of that asset. That means it's taxable. If it wasn't taxable, if it was deductible, we were going to have something like, something like that, right? But that's for a future video. But for now, let's focus on the fact that it's taxable, and our deferred tax at this point is 28%. 28% of 2,500 is going to give us a deferred tax liability, not an asset, because it's a liability since we are going to be paying this tax in a later period or a future period. This is how you get a deferred tax liability. Now we're also going to look at the current year, which is 2020. At the end of the current year, we have a carrying amount of 480,000. This is a continuation of the previous example that I did with you, because we know that the depreciation is 10,000 for the year and our carrying amount was 490,000. We just reduce that and we get to 480,000. Same with the tax base. We know that our tax allowance is 12,500 and it gives us this amount by the end of the year. So we have a temporal difference in this case, which has increased by 5,000, same as we did on the previous year. We tax that at 28%, and then we have a deferred tax liability of 28%. So when it's taxable, there are no brackets on the figure, but if it was deductible, I'm going to show you this on a future video, we were going to have something like that. But since this is not the case, it's taxable, so we have a deferred tax liability of 1,400. Now please keep note of the previous figure that we got, which was 700 rands, because we're going to be a movement in temporal difference. Now this is a very important concept which you are going to use when you do your disclosures on your notes of deferred taxes, and also when you are calculating your current tax expense. And if you don't know how to calculate your current tax expense, there's a link above there on the videos that I did on the income tax series. Now, our deferred tax liability in the previous year gave us a temporal difference of 2,500 and a deferred tax of 700 rands. In the current year, we have a deferred tax liability of 5,000 rands, as we just did earlier, and a deferred tax of 1,400. Now, the difference between these two amounts is called a movement. So our movement in our temporal difference is 2,500 rands. I don't know why I'm always saying 5,000 rands. And I do use the currency rands because I'm in South Africa, so our official currency is rands, right? Then the movement in our deferred tax is the difference between the two, which is going to be 1,400 minus 700 is going to give us a deferred tax of 700 rands. Now, if you were requested to journalize this in a journal entry, you would ideally debit the 700 rands as a deferred tax expense, and you would credit the 700 also as a deferred tax liability. Now, the expense is obviously going to be credited at the statement of profit. It's going to be debited at the statement of profit and loss, and the deferred tax liability is going to be credited at the statement of financial position, right? So if you had to do a journal entry, the deferred tax, the income tax expense of 700 rands would be debited to the profit and loss statement, and the deferred tax liability would be credited to the statement of financial position or a balance sheet. Now guys, this brings us to the end of the video. Thank you for watching the video. If you have any questions that you want to ask, don't be shy, hit the comment section and I'm going to address your problems. Now on the next video, we're going to be looking at deferred tax liabilities part 2, right? This is where I'm going to be launching this video on Friday, which is just tomorrow, on the 14th of August 2020. So please keep an eye out for that video where I'm going to be looking at the second rule, which will give us a deferred tax liability.